Hey, what's going on, guys? Today I want to show you this quick calculator that I made to just pretty much, create some illustrations of what your retirement income might look like. Obviously this can be scaled all the way back to like your 5-year plan, 10-year plan, and so on. This is just a quick little, web app I made, working on my programming skills, and I also wanted to create a valuable calculator that just the average investor could use. So I'll leave a link to this web app below. I think I've already made like a similar calculator to this before in like an Excel document format. Actually, I think it was Google Sheets, but now this is just a regular website that you can go to. You don't have to worry about like downloading the spreadsheet or anything. All you have to do is just go to this URL. But pretty much it's a very simple calculator. So as you can see here, the first field would be your monthly contributions, with a Roth IRA. Currently the maximum allowed is $500 a month or $6,000 a year. And then I'm not 100% sure, but I believe after the age of 50, so if you're 51, you can contribute $7,000 per year. I'm not 100% sure on that. I believe that's the law in place, but once again, I'm not a financial advisor or your source for that information. Feel free to do your own research or seek out advice from someone with professional licensure experience. But anyways, for all that rambling on, let's just say you want to max out your Roth IRA starting at, say 25. Roth IRA contributions currently, the way that it's set up, it goes to 59.5 before you can take out any of the earnings. But you can take out your contributions at any point without any penalty. But if you do want to avoid that early withdrawal penalty, it has to be there for at least 5 years from your first investment or first contribution. And then you also have to be 59.5 or older. So let's just say we're not going to need it right at 59.5. We can stretch that out until 65. So the next column is your average return. I put 7% in there, but Dave Ramsey is often advocating for that 12% return. But as you can see, your 5 million, that's pretty high. Let's scale it back a little bit more. Average a compound annual growth rate of 10%, and then the 4% rule. That's a pretty common yield percentage. Technically, I think the 4% rule is withdrawals of 4%. But me personally, I would much rather have a dividend of yielding around 4%. That way, I don't know. It just depends. Whenever I get to that age, I'll definitely have to consider, what type of investments I want to be in for income. Obviously, if you've seen some of my other videos, like the higher covered call ETFs, that could be an option as well. But I do believe with the 4% rule, you are investments that are still projected to get that 10% per year. So obviously, QLD and those covered call ETFs that are producing a much higher yield today are definitely not going to produce that 10% compound annual growth rate over time. So that'll be another topic for whenever that day comes. But as you can see here, let's just say the 4% rule, but contributing $500 a month from 25 to 65, you're going to be just shy of $3 million. So pretty good amount of money right there. Some things to note, inflation is not accounted for this calculator. That may be something I can add just to kind of get like a better sense of, obviously $2.9 million today is going to be completely different to what $2.9 million in 40 years is going to be. So, just because, the Federal Reserve is printing money and inflation is, supposed to be on average, 2 to 3%, preferably less than that per year. But, as you guys may have seen in the past year, I think it was like 6% inflation. So ridiculous numbers there, just with all the printing of money into the economy. So definitely something to keep in mind. But nonetheless, for this illustration, it's not in this calculator. So do keep that in mind. And then also, any type of expense fees or investment fees, typically that's going to be your expense ratio. Your broker may charge a fee, to have the account, but those aren't included in this illustration either. But with that being said, it looks like our retirement income based upon a 4% withdrawal / yield from our portfolio balance is at $116,844. So pretty cool. But do keep in mind, once again, the inflation for that amount of income is going to be significantly less in the future. So yeah, that's that. Let's see what you're going to be. So say you waited, 10 years to get started, which is, it's okay. Everyone has, different situations. But even waiting 10 years, you still could look at, being over $1 million in your retirement account. So many different variables here. So the biggest thing, I just wanted to create this tool so people can come in and, fill out the parameters with, their particular, age and hopeful retirement age and, what they're hoping to get on a compound annual growth rate basis and so on. So that's pretty much it for this video. I'll leave the link below. Definitely go check it out. This website, I think, has a couple other recommended books as well. This is a relatively new web app. I was just playing around with the new tech stack. But yeah, definitely go check out these two books too if you're new to. The first book is called Too Much Money. It's about, finding undervalued dividend growth stocks that are sustainable and are going to continue to grow their dividends over time. That was one of the first books that I read a couple years ago, and it really got me into this whole space of, the dividend growth investing, and yeah. So props to the author of that book. He has definitely changed my mindset a whole lot. And then the second one is all about covered calls. This is a good one to read as well. It just talks about a way that you can turbocharge your dividends. So, typically dividends aren't really huge amounts of money at first, especially, if you're investing into, say like a Starbucks where it's like less than 2% yield, or, a Coke is probably 3 or 4%. So, it's going to take a lot of money to, make a significant amount from dividends from that. So, with covered calls, if you understand options and how those work, it could be a way that you could almost hedge your position in, down / bearish market, or, it's another way that you can, just increase that yield over time if done correctly, with, the covered call premium. Do understand that, covered calls, they cap your upside. So obviously if you sell the covered call, $10 out of the money, and then somebody tweets, a CEO tweets, or, some kind of news really pushes the stock either up or down. If it shoots up $30, selling a covered call, you're capping you're capping your gain potential. So do keep that in mind. It's just another way that you can, create some cash flow from your dividends, dividend positions. All right, guys, that's it for this video. Thanks for watching. Feel free to like or comment down below with any questions that you may have or any suggestions. All right, guys,